of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In today's video, we're going to discuss a little bit more about the Fed as we come into the Fed meeting on Wednesday and what they're likely to do and what they're not likely to do. Let's get into today's video. Welcome everyone to the Kendall Report. There is virtually nothing going on. I would have to say that maybe Tesla stole the show today, and it was a pretty impressive move to say the least, but I think it might have been misinterpreted because the headlines on Bloomberg and all of them were saying that there's some kind of deal struck so they can use their FSD. But I think what I read was that they have to use the Chinese networks, not the Tesla. They don't have access to the maps. So I'm not sure it was that big of a deal, but they are running that stock crazy. And I think maybe we'll spend a few minutes talking about that today. I think that, and Daniel, you're right. I've said this before. When you got a guy like Musk and run this up like this, and no offense to any millennials, but millennials will pay any price for any stock. They showed that in 2021, and they rode it all the way down in 2022, and it was a disaster to say the least. I mean, you know, there unfortunately a lot of fans of Cathie Wood, who's probably destroyed more equity in the last 10 years than anyone else. But the point is that they're just bidding the stock up. The question now is, where do you sell it? Because if it's interesting, because I'm really not a very traditional TA guy, technical analysis guy. I have some of those elements, but most of the things that I use and talk about are my own proprietary indicators and all the things that I've developed over the last 40 years, not what I read in Edwards and McGee and trend line books and all the basic stuff that's out on the internet. And everybody that's out there, especially the younger trading community, has bought into all these things like they actually worked and they never did, which is the irony of a lot of this. And so, as far as the markets go, is pretty much, you know, just a consolidation, slight bias to the upside, not a lot going on. Only a couple sectors were negative. And, you know, we got really the big news coming out on Wednesday, which is virtually nothing, okay? The Fed is expected to do nothing at all. Everything's going to be on hold. You know, who knows what kind of metrics we'll get after this, but everything we've seen so far tells you the Fed doesn't need to raise, lower, do anything, and that's what the markets are expecting. And like I've been trying to advertise, and I know I talked about this a little bit in yesterday's video as well as in the Substack, is there just seems to be a lot of complacency. Usually this is just hype time. I mean, everybody's nervous and anxious about Wednesday's conference call and what Powell's going to say. I don't hear any of that. Maybe you folks can tell me something different, but I don't hear any of those things, that kind of noise in the markets. We really have, let's look at what economically comes out, and I don't suspect that today's going to be a very long broadcast. I'll try to get done in about 30 minutes today. I don't see a lot to talk about. Tomorrow we'll dig into some of these stocks, and you know, I kind of feel sorry for Meta. They actually came out with decent earnings, and they're just getting hammered. And Tesla missed by big time, and it's going vertical. The difference between Zuckerberg and Musk, right? So, and let's take a look at. So tomorrow we've got the economic cost index coming out. You know, I don't see that as a big deal, but it's up, supposed to be up 1%. The FHFA housing prices are coming out. They don't even post any kind of forecast, but Case Shiller comes out, and that's expected to be 6.7 year over year. And just a side comment here is we're always seeing these things being talked about that somehow the housing market is collapsing and all those stories. And then the other story that pops out all the time, there was a Pennsylvania bank that went down the other day, and that's a big deal. And there's people out there talking about the banking crisis is coming again. Folks, listen, I've been around a long time. Most banks that are out there, there's 5,000, almost 6,000 banks in the U.S. These things fail all the time. They're run by people that don't even know how to run businesses, some of these banks. And back in the old days, there used to be the good old boy banks that were a whole group of doctors and businessmen would get together and they all wanted to have a bank in their local town. These things are terrible entities, and there's nothing to be garnered from talking about these. If you recall when the last year Republic and the other Republic and Silicon Bank, when those were happening, I think that was around the time, or shortly after, it was a year ago, I did the Meet Kevin interview, and I was telling him then, and I'll tell you now, there was no banking crisis, there was no recession coming, none of those things ever happened, and the reason why is because these were normal events. They were banks that were run and mismatched assets. And I remember Dr. Baker and I spent a lot of time talking about this stuff, and even I believe we did a Twitter space on it as well, just talking about how easy it was to fix, and it was easy to fix to basically the Fed discount window, and that's what it's for when there's dislocation of capital. And Silicon Bank should have never happened. That was just totally caused by the California regulators. That was just poor management at the bank, poor regulators, and I could be wrong, but I think this entire country is run by just a clown show on all aspects, especially on the regulatory side and everything that we see going on. So I won't go too deep into that. So let's talk about something that on the Fed, I keep kind of referencing something that if the Fed was going to make any kind of move right now, it's so quiet, the expectations are so low, this is perfect timing. I would love to be in that meeting that starts tomorrow. Not that they haven't been talking every day up to this, but I would love to be a fly on a wall in there, because I think what you would hear is something very interesting. You would hear, hey, we could do this, we can do that, we could shock the market here, we could move the meter a little bit the direction we want. So they have more opportunity, I think, in this particular meeting to do something than any other meeting, because they're almost been mandated on every meeting on what they're expected, and every talking head on Bloomberg and CNBC and everybody out there on every channel was talking about this is what they're going to do. I don't, I went through, I don't read a lot of this stuff, but just scrolling through news that I normally look at, I don't see the dialogue out there. So there's no ongoing bailout. This is the way the bank, listen, I've been around a long time. I worked strategically with banks as a consultant, some of the major banks. Some of them aren't around anymore. But this is just the way the system always works. It's a fractional banking system, and it's always been like that. That's not a bailout. This is the way the system has been structured for decades and decades and decades. So this is not, it's just not a thing, okay? And that's why I would confidently say what I said last year, and it's just not a big thing. And listen, when the Fed went to the zero, basically there's no requirements on the banking system like there used to be. They've changed that. Banks keep assets above their deposits on the books, but they're not required to. The Fed made it clear they were the lender of the last resort. They did this in 2020 in the pandemic. They changed the rules, and they just made it clear, we'll hold all the assets over here on our side, and we'll make sure everybody has money. That's just how it was basically restructured. And since they're we'll say a non-regulated, which they aren't entity, there's some oversight, but I'm not sure what that is. I've never seen any oversight of the Fed. They've always done what they want to do. And anyway, I don't want to get too deep down that, because we could do a whole show just talking about some of the things that are there. But it just need to know that they're not going to allow any big bank. We're not going to have a 2008 GFC, not at this moment, not from the configuration that we're in right now. I'm going to let it go at that. But what the Fed can do right now, and this is even, in my opinion, more important, is what they can do is they can start. They could do something with QT here that could be very positive. They could make it an announcement this time that they're doing something with QT. Everybody's focused, and I've been saying this for a while on this channel, everybody's focused on the front end of the rates and the Fed funds and that level. That's so unimportant right now. It's unbelievable. What's really important is what they're doing with selling these bonds and the QT. That's way more important than some front-end interest rate. Nobody does really. It affects the banking system to a degree, but these are good levels, because banks can actually still raise money doing CDs and other types of things in this higher front-end rate, so they can do those 6-month, 1-year CDs and bring in a fair amount of money at a reasonable rate, especially with their bigger customers. They can't, I will do air quotes, they can't demand it, but it's kind of expected that maybe you keep a bunch of your deposits of your company here and we'll pay you a reasonable amount. You can put some in CDs and structure it on the front end of the curve. The back end of the curve matters way more, which is where mortgage rates and other economic elements lie. But for right now, they can move that meter just a little bit and have some reasonable effects. And I'll go through the Treasurys here in a minute. I'm getting a little longer in the tooth than I wanted to on this particular topic, but this is something that I think that we need to watch for in this meeting. Now, just real quick, we're going to move on and go through some of the metrics, look at the charts. We'll go through the rest of the show. It should take me 15 minutes, give or take a couple. But one of the things that I think we watch closely here is what happens with that back end of the curve. And I did tell you that both in Substack and on the broadcast yesterday, expectations for rates to come back in a little bit on the back end of the curve, but still stable above 450 is the bottom. So I'll go through all the details here, but this is just an opportunity that I see here, just because if you think about it, this is the final comment on the Fed. If you think about it, they've done exactly what the markets and all the noise and every announcer and talking head in the marketplace has told them they should do every time, right? There was some expectations of yield being dropped, but everything, and if you look at what they're doing as they're told. They're really walking the line, and they're trying to let the markets do it for them. This is the one meeting, I think, that they have an opportunity to do something different. Well, I have no clue, but they do have that opportunity. So let's do this for the balances show. Before I do the rest of today's broadcast, I told you I might not be here on Wednesday. I will do a video on Wednesday. There will be one on Thursday, but I'm not sure of the timing. It may be intraday live that we do something. I've marked down for my notes here that the last hour of trading on Thursday will be it. I'm out of town until Sunday, so after that. So just know Friday, with the employment numbers and all that stuff coming out, that's going to be a big deal, mainly because whenever I go out of town, I don't know, I wouldn't say bad things happen, but a lot of times it does. So let's go ahead and we'll just quickly go through. We're not going to touch on the WaveTech database. If you want that information, you're going to get that on the Substack, and that's kendallreport.com/newsletter. That will get you to the newsletter. Sign up. There's a 7-day free trial, and it's $8 a month after that if you want the premium content. And there's a part of it, my opinion and basic overview of what happened in the markets is free every day. So let's go ahead and we'll go ahead and go through some of the markets and be done with today's broadcast. Okay, so we did see a slight more positive as we came, this daily chart on the E-mini, and we did see a little bit of a positive tone. The numbers that I laid out yesterday, I spent a lot of time talking about them in Substack as well, 52.20, 52.37. One of the numbers I didn't emphasize as much, but we're trading on it right now, is the 21 period moving average simple. It's 51.51. The high so far, 51.48 overnight. And then there is one more number above that at the 40-day moving average, which is 51.89. And then there's those pivot numbers at 52.20, 52.37, which is Fibonacci target 1. So all of these numbers are in play, and I would look at them as hurdles to get over. If we can get just above this, we'll probably get a decent chance as we come into Wednesday to print higher. It looks like the way things are set up, if the algos are close to being right, that we'll see a positive move into, probably into Friday. So I don't expect anything to be negative. And like I said, they have the opportunity, the Fed that is, to do some things that would probably be a little more positive for the markets. And let's face it, I've talked a couple times here about some of the events that I think are going on, earnings manipulation, and how to make a positive configuration for the markets during these periods of time. The Fed's not going to rock that. Let's face it, they want the markets to be positive. What advantage is there to having the markets crash? There is none. And as long as there's plenty of people still talking, as long as Peter is still out there, you can figure out that is, talking about the markets crashing and all those things happen, it's not going to happen, right? So, but this configuration here on the daily chart does suggest a positive mode to the upside. If you look at the market grid, you're going to get some decent expectations here. I'll bring it up. It's over on the, let me get off screen here. It's on the far right-hand side. 51.78 is R2, 51.61. That would be just a slight break over the levels we're at right now. Support tomorrow is going to be 51.32, 51.15 as an extreme. We should stay well within those ranges, especially prior to the prior to anything. And somebody's asking a question, do your indicators work on other indices? Of course, yeah. It works on all this stuff. We will do Apple tomorrow, okay, John? So we're going to stick to just the indexes here. Let's go ahead and, I don't see anything really set up other than those numbers. Let's go ahead to NASDAQ. So NASDAQ, similar type situation. As I talk about often, a lot of these indexes have, especially S&P and NASDAQ, have a lot of common elements. NASDAQ has a slightly higher beta than the S&P does, even though the S&P is the leader so far this year as far as the patterns go and the returns, just by an edge, right? Just a little bit. But you can see even the algos here are forecasting for some higher prices into Friday, and we have different numbers but same configuration, and we don't have the upward fib targets that we have on the S&P. And I think I would put the S&P as a bit of a leader in this pattern that we're in right now than a lag. Any kind of lag. Normally the NASDAQ has been the leader in this, but we're not seeing that in this current environment. So, but here's the numbers. The 21 period moving average right now, 17,000. 960, and then we've got the 40 period at 18,127, and right at 18,000 there's a lot of resistance there. Like I said, we don't have any upward projections, and I would just use the market grid numbers that are over on the side here, which are R2 18,055, R1 17,975. Support is 17,832 and 17,752 is going to be the numbers to watch for tomorrow. Should have a quiet range. You see the last 3 days we've been starting to quiet down after that big day last Thursday where we had the big crazy reversal pattern. What we're seeing is we're starting to see the volatility contract a little bit, so we should stay within these ranges. Those upward targets would be if we had a reason to get an acceleration, that would be the case. All right, so the Treasuries 10-year is trying to break back below the 10-period moving average just a little bit here. We should come down toward this 21-period moving average, put us around 455, 450. I don't see us getting below that. And you see the algos are kind of flattening out and staying basically neutral as far as it goes. So we should see the key number to watch is going to be this 21. The PPM2 is going to be looking like maybe early next week we could see a breakdown, but it looks like we ultimately challenge down here at this 450 level, and then that should be solid. This thing's going to be basically boring from my standpoint as far as the interest rates go. I don't see that it's going to have any major volatility, and most of it should be downside, and maybe that has to do with the possibility of the the Fed maybe revealing something about QT, and that would take a little upward pressure off the back end of the curve. We'll do a quick review of crude oil. We're looking at probably stability from right in these levels here. We should start to turn up, I think, in the next day or two, and we're going to be locked range here in around $82 on the downside, and about 83.5, 84 for the next couple of days. And this is a nothing market. I'm going to go over to the weekly for a second. And this is something that I've told you about before. We still have this upward slope on the trends from the standpoint of what the algos are suggesting. I think we will ultimately, and I feel fairly strong about this, see a 90 handle, maybe even 95 as we go down the road. Yeah, so I see a comment on, is there a rug pull on the Fed? I don't think so. I don't think that's what you get. I think you see more pretty much just walking this thing forward as it is. There's no advantage for them to do any kind of rug pull or anything, and they're just going to keep the line of what they're doing. Like I said, the only thing they're likely to do is pull back on QT, which is going to be more positive than negative. So I'm just going to skip forward here to Bitcoin. Let's do that, and then I'll come back up and talk for a couple minutes here. All right, so I've got the weekly Bitcoin, and I want to point out something. We're starting to get some bit of a channel on the downside forming here. There's still some valid fib targets up and down, and it's interesting because the dialogue around this market is all these different countries. I think it's like New Zealand, something which are like 3 people live in New Zealand, in case you weren't aware of that. It's very low population. They're going to get an ETF on Bitcoin. There's a couple other, and somehow there's all this demand that's coming into Bitcoin. What we're seeing is the opposite. I think what we're seeing right now is a distribution pattern that's setting up, and when I bring the algos back up, you're seeing basically almost a move down to the 21 period moving average. I discussed this in the Substack last night, that we're probably looking at a move down, at least at the moment, down to around 55,000. There's a chance to see a 40 handle, and it's just, there's so much bias out there, and so much. If you go on some of the fanboy Bitcoin channels on X, you'll just see they're just going on and on about this. They're still working on a frenzy even after an event that was so advertised, like 3 years, 4 years ago. Everybody knew this halving event was happening, and it's like somehow that was going to be a surprise and everything was going to happen. And my argument was, no, it's not. The patterns aren't saying that at all. There's nothing here. I'm going to go over to a daily chart here as I'm talking, and what you'll see here is actually, let me expand this chart so you can see it a little better. This is the daily. The daily's getting a slight bias, so we could see a bit of a rebound here. Not a lot, but there is some fairly new fib targets here that are likely, that could be hit, and that's going to put us around 67,000, and we're projecting back up for another run back at this highs. But if I went back to the weekly chart, you'll see all that is the weekly volatility. So when we start to look at this chart here, let me just kind of bring this in so you can see it a little better. All you're really looking at from this level is the patterns that are unfolding, is really just the volatility patterns, is really the weekly volatility patterns. This is not any kind of new trend or any kind of breakout, even if we print it up to 67. You look at the market grid here, the R2 is 67,000 and right at 67. R3 is 69,000. And then we look at the other side, S1, 61, S2, 59. So we're just still trading within that grid. I've been going on for almost 8 weeks now about this. That's all we're going to see on Bitcoin. We're still just working this pattern. And this is a big, I believe it's a fairly big distribution, just because of the bias, I would say. There's way too many people that are believers. I'm not saying it's going to collapse and go down to zero. What I'm saying is it's not going to go up right now. And that's pretty, when you start to look at the algos and everything, they are very consistently projecting this stuff, this lower levels on this chart. Okay, I'll come back up here, folks, and I will. Just looking at some of the comments here on the page. David, I'm sorry. Listen, David Nichols is talking about, we had some nasty bot that got onto our Discord, and I'm really sorry about that. I am going to make some of you probably make you moderators on there so you guys can get rid of those. I don't spend a lot of time on there. And Constantine is the one that actually alerted me and sent me a DM. So anytime you see that, if you can send me a DM, and that I'll take care of that. Discord's famous for that stuff, and we don't get a lot of them. And it's interesting that they broke through that firewall. So it just shows the vulnerabilities there in Discord. Anyway, so folks, listen, have a good day trading. Tomorrow we'll go through a lot of detail. It won't be, I'm right at 30 minutes, so I'm going to end this one today. But just know tomorrow we'll start to concentrate. We'll do Apple, and we'll go through a bunch of stocks tomorrow like we usually do, and I'll try to set this up fairly good. And I'm going to tell you right now that I am working on something. There's going to be, I haven't figured out exactly how it's going to integrate, but I worked on it today a fair amount, but there's going to be a new section in the newsletter that is going to talk about just portfolio management and some different reviews. I've got some ideas and some metrics I'm putting together, and I've been working with ChatGPT to do a bunch of analysis on some of the strategies we have out there. So I'm working on trying to apply, and I'm trying to validate some of the metrics that it's coming up with to make sure it's good stuff. But anyway, there is some new stuff coming in on the Substack as well, and that may end up being a freestanding. I don't need another job, but I do want to have once a week review on some of the stuff. There's quite a few of you that use our WaveTech software, and so I want to make sure there's a community that starts to form out of there. Anyway, so thank you so much for watching today. I appreciate it. Have a good day trading. Bring some stocks that you want me to review tomorrow. We'll talk to you tomorrow at the same time at 7 p.m. Eastern. See you then.